Joining us right now to talk about the market response to the president's China trade comments is Alec Young. He's managing director of global markets research at FTSE Russell. And Alec, it's good to see you.
Yeah, great to be here.
What do you think if there is not a trade deal that happens, even a skinny deal that some people had been anticipating? What does that mean for the markets?
Well, I think the market run-up definitely has been predicated to a certain extent on at least some kind of a skinny deal, an ad product buy in exchange for perhaps some movement on intellectual property. When there was word that that had entered into the talks, I know the market responded very favorably. Obviously, the December 15th tariffs, waiving those or delaying them, moving them out of implementation, I think is going to be expected.
If there's not a deal that's reached, the Chinese have now not only said that they don't want those December 15th tariffs to come on, but they would like the original tariffs to be removed as well.
I think there's obviously downside risks, especially in light of the weaker than expected manufacturing data yesterday. So if the positive inflection in global growth that people have been hoping for is a little more fragile than thought, obviously we're more sensitive to problems on the U.S. China trade front.
Does that mean risk off? You would not put?
Well, I mean, I think it risk off to S&P 3000 maybe, but you know, let's keep this in perspective. I think there's a tendency, frankly, in the financial press to overreact to the president's commentary. We've seen this movie like 57 times.
Yeah, that's why let's not worry about the comments right now, but let's talk about the real things that might matter. We are approaching that December 15th deadline. What would matter to the market? What wouldn't?
Well, if those tariffs go into effect, that would be a negative. I think that potential is being priced in this sell-off as we speak.
A sell-off under 100 points.
How negative for the Chinese economy?
Well, first off, let's remember that both sides have an incentive to do a deal, and that's the market calculus. The president does because of his reelection. The Chinese do because of the softening in their economy. So the market won't like it if the December 15th tariff go into place. It's selling off on that possibility, but that doesn't mean that we get a bear market. It doesn't mean that this rally's over. You know, you have to take things from a measured perspective. I think there's a lot of gray, and there's a tendency to want to view this as a black and white issue.
So, in terms of the run-up that we've seen in the markets, Dow up by, I think, 4.4% over the last couple of months, S&P up 5.5%. Those are some really strong moves. To this point, we've kind of been talking about December being a place where you could see an additional sort of rally, and even a Santa Claus rally at the end of December. You think that's still on the...
I think a lot of it has to do with what you're talking about around the tariff for December 15th. Certainly the seasonality, we all know, is favorable. I think one of the risks, though, this year is that we've pulled a little bit from next year's performance, because until yesterday, you could really ask yourself what good news hasn't really been priced in. You had a lot of complacency, a lot of optimism. So in a way, this digestion is good. It resets expectations in a little bit more realistic territory. It does set us up for the Santa Claus rally.
I mean, you're talking about digestion. We're talking about a move of just over 1% when you look at yesterday's losses and combine the futures this morning.
I think we could see some follow through to 3,000 on the S&P, which would be about 150 points. So, you know, it might be a slightly 3 or 4% move at that point.
If that happened, though, you said that would be a good thing. You would tell people to go ahead and put money to work at that point?
Yeah, because I'm not ready to accept that the trade talks are going to completely collapse. Yeah. We've seen this 2 steps forward, 1 step back dynamic for a long time.
So even if December 15th deadline passes, the new tariffs go into effect, you feel okay because come January, February,
right.
March,
it's all about what the market's priced in, and if the market's fallen 3-4%, I think the market will have priced that in, and then it'll be like, okay, what's the next step? If we get another major disappointment in the new year, I think the market may take a slightly more negative view. But right now, the core view among investors globally is that both sides have an incentive to get something done. They have more of an incentive to move forward than they do to see a re-escalation.
How do you like U.S. stocks versus international stocks?
I think at this point, you definitely want to be looking at rebalancing up the international exposure. Everyone knows how great the U.S. has done. But historically, when you see this kind of a spread between asset classes, it's when you start to see some mean reversion on the upside from the weaker asset class. So I think most people have exposure to international. It's gone down because of how much the U.S. has outperformed. I think rebalancing international up makes sense now. If international growth, we saw in the PMIs yesterday, the U.S. disappointed, but China and Europe actually beat a low bar. That's the kind of catalyst we need for the dollar rally to cool off, and a weaker dollar helps international.